Hi Pärtel, nice to see you again. How are things going at Bondora?
Hey, thank you for having me on the show. Things are actually going very well. 2024 was a strong year. We grew loan issuance by 30%, and we crossed 1 billion in investments. Also, we remained profitable for the 8th consecutive year, and also expanded into new markets like Latvia. And we also got permits or approvals to enter Lithuania and Denmark, two countries where we've now slowly also started our lending activities, whilst very, very gradually as part of a measured rollout. Also, just as important to growth, we've kept a very strong risk management focus. We've shifted gradually over the past years towards lower risk loan profiles. We've very actively managing defaults through the courts across all of the jurisdictions, and we're continue to create very, very predictive data-driven underwriting models. So overall, things are going great, both in terms of growth as well as sustainability of the company.
Yeah, I've been investing on Bondora since I think it was 2016 or 2015, quite a while. And I've been also analyzing the annual reports of you guys since 2019 until today. And I find it quite interesting. The balance sheet grew threefold, basically, from 7.5 to 21 million euros in your last annual report. But the profitability was 2.2 million 5 years ago. Now it's at 1.2. That's also around 60% less than in the year before, mainly due to an increase in doubtful receivables. What's your take on this?
It's actually quite straightforward. The decline in net profit and the increase in doubtful receivables in 2024 is primarily due to a one-off accounting adjustment related to changes in our internal fee receivables provision model. So more specifically, the change relates to Bondora's own fee receivables from borrowers, rather than the loan principal balances which are held by investors. And as we are preparing for a bank license application, we've aligned the fee provisioning standards and the way we account for fees and the way we provision them to IFRS 9 standards, so that we're ready for the future. And that has meant that we've retrospectively or retroactively applied it across all of the past receivables that we've generated since, broadly, I think, since 2012, leading to higher one-time provision expenses. So, importantly, this change does not indicate the deterioration of the underlying profitability of the business or the loans, but rather reflects a necessary one-off alignment with the regulatory standards of a supervised financial institution.
Okay, understood. So you had these receivables accounted for many years, not just the last year.
So it applies to the receivables from all the prior years.
Yeah, because it quite stood out as 27% of revenues. I thought there has to be some other reason. Yeah.
Yeah, the kind of part for 2025 or 2024, the impact of the new model standalone basis on 2024 versus the previous model would have been quite marginal. So it's just more of a longer time, because it applies to all of the past sort of periods where we've had this kind of like a fee components.
All right. So if it goes further this way, I would expect much higher profitability for 2025 if you don't have this one-time effect, let's say. Would that be right?
Yes. So it was one-off accounting adjustment. So for 2025, it doesn't sort of apply anymore. So the profitability expectations going forward are actually meaningfully higher than for 2024.
All right, cool. And Bondora Go and Grow is your one product that is the most attractive thing for most investors. And it has basically been the same since it was launched. But now there are more and more competitors who offer, well, a little bit similar or a little bit different products. They add some things to it. For example, Monefit, they added the vault, where you have a little bit higher interest rates, but also fixed duration instead of the option to withdraw daily. Is that also something that could be interesting for you?
We're actually not planning to launch new investment products at this time. Our customers value stable and attractive returns, high liquidity, and a simple, trustworthy user experience. And that's why our focus remains on Go and Grow and what we've built so far. So rather than broadening the product range, we're actually committed to enhancing the Go and Grow further by improving the user experience, improving transparency, ensuring it continues to deliver strong long-term value. There are various things that we're looking to do around the value propositions to make them stronger. We're continuously looking at ways how to, make what is there stronger, better. We're also looking at ways how to bring in, add-ons that the community has been asking for. We're exploring Kids accounts, we're exploring loyalty programs. At this stage, they're still in, let's say, discovery phase, but I'm sure in the next 12 months you'll see more product innovation coming out, but the foundation of Go and Grow, what we've built in terms of the liquidity, in terms of the stable return, that will remain strong and become even stronger.
Mm-hmm. All right. Okay. And let's stay with Go and Grow for a moment. How come Bondora didn't raise the interest rate on Go and Grow when the ECB interest rates were a lot higher? But now, Bondora is lowering the Go and Grow interest rate for the first time since the product was launched. Why is that?
So with the recent adjustments, we focused on simplifying the product and making it fair for everyone. By removing the 4% unlimited tier and moving to a single clear return of up to 6%, we eliminated the monthly investment limits and ensured that all investors, regardless of how much they invest, make the same return. Even with the rate adjustments, Go and Grow continues to really stand out because we're offering a stable return above what traditional banks are offering. We offer near instant liquidity, low fees, in a tax-efficient, hands-off experience. And it's backed by long track record. Go and Grow has been on the market for now since 2018. It's 7 years already, and there's a big birthday campaign to celebrate that already on the market as well.
Mm-hmm. Mm-hmm. And when I look at the portfolio composition, you guys have been publishing more information in the statistics page and also on the blog. The interest generated in the Go and Grow portfolio is far above the 6% level, which is the interest rate right now. How does Bondora determine exactly when you guys would raise this interest rate?
Sure. So whilst the interest rate on the loans is higher, then setting the Go and Grow rate, the target rate, requires factoring in more than just the loan returns. So we also account for necessary risk buffers. We also account for necessary liquidity buffers, buffers for operational expenses, and also the investments necessary to ensure that the business remains resilient as we scale and prepare for the bank license. So all of these things are carefully calculated to ensure that we can consistently, over years, deliver on the Go and Grow score value proposition. Stable and attractive returns with near instant liquidity. Whilst ensuring that the investments remain intact and investors get the return. So even at 6%, which is a very high return, the return is highly competitive compared to traditional savings products and can be viewed as a liquid, higher yield alternative with far greater flexibility.
Right. And would there be one big point where you say if the returns are far higher than we predicted, defaults are lower, would you then raise the Go and Grow interest rate? Like, how would you determine that?
So the Go and Grow interest rate, it's not an interest rate, the Go and Grow target return, any future changes really will depend on the competitiveness in the market, right? So what are the alternatives? What are the appetite for this product on the market? And to ensure that we can internally do anything possible to guarantee that we can deliver this return, right? So whilst due to regulatory limitations, we cannot explicitly guarantee the Go and Grow target return, then internally, the team is working, day in, day out on risk management and everything around it to ensure that we can deliver what we promise.
Okay. And do you worry about your large proportion of loans from Finland? My second home, I saw in your recent statistics, out of 30 million euros in financed loans for the last month, around 20 million were from Finland. And they usually have a higher risk scoring according to Bondora's own risk scoring. What is your take on the large proportion of Finnish loans? Okay.
So whilst occasionally the actual observed default rates in Finland have been higher at different periods, then the general trend is that both the predicted as well as the actual observed risk rates in Finland are lower than in Estonia. So, more broadly, there's really no reason for concern. The risk level is fully within our control. As we set the approval thresholds in each of the country based on our data, the models and risk appetite. So we only approve loans that are profitable and meet our target risk return profile. And if ever needed, adjusting risk levels is actually quite straightforward in any market. It's an operational decision that we're today well equipped to implement within hours. But overall, I think, you're referring to that there is a bit bigger share of like B or A loans in Estonia, but actually the share of D loans and others in Estonia is also higher than in Finland. So, but overall, Finnish loan risk levels are actually overall as a market total predicted lower than in Estonia.
Mm-hmm, mm-hmm. Would that also be compared to other markets you're active in, like your new market of the Netherlands?
The Netherlands expected risk levels are actually generally more or less on the same level in Finland, or long-term predicted to be lower than in Finland. So, when you think about expectations of risk levels in any given market, then what we look at is three different things. First of all, the baseline is that we always ensure that all the lending that Bondora as an originator does is compliant and responsible, both according to the local rules as well as what we consider responsible in Estonia. Secondly, then having ensured that these loans are fair and good for the borrowers, we need to make sure that the risk profile and the interest rate of the loans actually align. So we have risk-based pricing, And that means that, in certain countries, in certain periods where the risk levels are lower, the interest rates are lower as well, right? And finally, there's a limit, like an interest rate limit that's different in every different country. Therefore, the risk spectrum of any individual country is actually somewhat different, because the level of interest rate in different countries is different, and set by regulatory authorities in that specific jurisdiction. And that means that, let's say, the depth of the risk profile in each country is somewhat different. But overall, what you can see in every single country we're operating in, and the general trend is that we are moving more and more towards like lower risk profile in every single country. In case a new country is launched, then the risk spectrum is a bit wider. However, the loan lending volumes in all new countries are actually very, very low. So we have a sort of low and steady sort of growth plan in every country, which is more or less a period of 18 months, where we're step by step increasing the lending volumes, calibrating the credit models, updating our sort of like lending guidelines, until we consider that market actually mature enough to start scaling. And by that time, when we start scaling, the risk profile of that country is already optimized to be on the lower end.
Okay. And you've hinted a few times that Bondora wants to become a bank. At which stage in the process are you, and how long do you expect this process to take until you are a bank?
It's a good question. We've made very strong progress in the past year. However, it's a process that for many companies takes overall, up to 3-5 years in total from start to finish. Because it's not simply a document that you file, that you file an application and then you become a bank. It's sort of like submitting your university sort of application. It's something that requires you to, in a way, rebuild the entire organization. How your governance structure is built. What kind of people you have on the supervisory board, how the supervisory board is set up, how the management board is set up, what kind of internal risk controls you have in place, internal audits, what's called second line of defense, which is kind of compliance, risk control functions. That takes quite a lot of time. And, we've been on this journey for a bit of time, and we've made excellent progress in the last year. But, we continue to work actively with the regulators and moving at an expected speed. So I can't really specify a date when we get the bank license, but every day we're becoming more of a bank than the day before.
All right. Okay. And a little bit a different outlook to the future. Many companies have started to launch similar products to Go and Grow, because it was such a success. If that's now in consumer loans or even real estate rentals, all kinds of industries. But you were the first mover. So how do you see the market for this high liquidity peer-to-peer lending in the future?
So, in essence, the time really shows that we were long ahead of the curve when we launched Go and Grow in 2018. It's been 7 successful years for Go and Grow by now. But while others have been trying to replicate certain aspects of Go and Grow, then Go and Grow continues to really stand out and to be top choice for our investors, because it offers stable returns above what traditional banks can offer. It offers near instant liquidity. It offers low fees. It offers a hands-off experience and a tax-efficient structure. And all supported by now what is 7 years of 7 years of track record. In other words, many companies on the market try to copy the parts of what we've built, but we see no other product on the market that really brings together the level of returns, the reliability, simplicity, the liquidity, and scale that Go and Grow provides. So as the market matures, we believe that the winners will be those that can deliver those things and can do it consistently with trust and real value over a long period of time. And that's exactly why we think that Go and Grow continues to lead the industry. And we'll do so for a long period of time. And we really benchmark internally Go and Grow to the traditional savings products and traditional sort of investment products rather than B2B lending where we started out. And we rather looked at not only our product is highly competitive with the alternative investments industry, but it's highly competitive with what the traditional banks can offer and also what ETFs are on the market.
Thank you for that. And the last question would be, you also hinted already in the interview a little bit towards new product capabilities and that you're still working on the bank license. What else can investors expect, let's say, in the next 12 months from Bondora?
So I said before, we're really focused on delivering the value proposition to our customers, and in the context of Bondora overall, on the credit side, we're committed to providing a simple, responsible, and compliant access to financing. And for investors, we continue to offer stable returns higher than what traditional banks can offer, combined with near instant liquidity. So the exact products or features we're going to roll out are predominantly driven by what feedback we get from the investors. But our plan is not to sort of add all kinds of bells and whistles. We really want to make changes that make the core value proposition stronger and stable across a long period of time. Because we see, and we've already experienced now for 7 years, that the customers who use Go and Grow are predominantly long-term investors, long-term savers, rather than someone coming in to try to sort of like trade or make a quick buck. And that long-term sustainability and stability of the company itself as well as the product is a key differentiating factor. So therefore, on top of the priorities, for growth and product innovation that we've slightly touched upon, what really remains top of our list internally is maintaining strong risk management, maintaining strong operational efficiency, and continuing the preparation for bank license application. Anyone who goes back in our history, I think that we don't need to prove that we can innovate at different times. We've been a leader throughout different periods, both on the sort of investment space. We've been a leader in innovation both on the credit space, but looking ahead, everything we do must be aligned with our strategy, building long-term customer relationships, ensuring strong financial performance, and driving sustainable growth.
Okay, thank you very much for your time, Pärtel. Thank you for that information. And I really look forward to what you'll come up with in the next months and years. It's been very interesting to follow, to say the least.
Thank you, Alex. It's been a pleasure to be on the show.